other geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, growth could turn out to be higher if the economy and energy markets were to adapt more quickly than expected to the disruption caused by the war in the Middle East, or if the war was resolved promptly and sustainably. Moreover, planned defense and infrastructure spending reforms to enhance productivity and the euro area firms adopting new technologies may drive up growth by more than expected. A deeper integration of the single market would also boost growth beyond current expectations. The risks now to the inflation outlook are to the upside. If energy prices were to rise by more and for longer than currently expected, euro area inflation would increase further. This could be reinforced and become more persistent if higher energy prices were to spill over by more than expected to other prices and to wages, if longer-term inflation expectations were to rise in response, or if global supply chains were disrupted more broadly. Ongoing trade tensions could also give rise to more fragmented global supply chains, curtail the supply of critical raw materials, and worsen capacity constraints in the euro area economy. Extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. By contrast, inflation could turn out to be somewhat lower if the economic effects of the war in the Middle East proved to be more short-lived than currently expected, or if indirect or second-round effects prove less pronounced than anticipated. More volatile and risk-averse financial markets could weigh on demand and thereby lower inflation as well. So looking now at the financial and monetary conditions. Financial conditions are broadly unchanged since our last meeting, but remain tighter than before the war. The cost of issuing market-based debt rose to 4% in April from 3.9% in March. Bank lending rates for firms remained at 3.6% in April, and mortgage rates at 3.4%. The annual growth rate of bank lending to firms increased to 3.4% in April from 3.2% in March, while the growth rate of corporate bond issuance rose to 4.6%. Mortgage lending in April again grew by 3%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks are resilient, supported by strong capital and liquidity ratios, solid asset quality, and robust profitability. However, a sudden, sharp drop in asset prices, potentially amplified by the non-bank financial sector and deteriorating asset quality, particularly in energy and trade-sensitive sectors, would pose risks to financial stability. These risks increase the longer the current geopolitical conflict lasts. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we now stand ready to take your questions.
The first question today goes to Balazs Koranyi of Reuters. Balazs, please.
Good afternoon. First off, allow me to say a big hello to the newest member of the trio on stage. Welcome, Boris. President Lagarde, could you give us a flavor of the debate today? Were other options discussed, perhaps a hold, perhaps a larger increase? What were the arguments put forth in the discussion? The second question is about your reaction function. I'm curious how many more rate increases are embedded into the staff projections. What do you need to see to deliver on those? And will you have that sort of volume and quality of data available to you by July to make an informed decision?
Thank you very much for your question, and thank you for greeting the three of us, and particularly Boris, our new Vice President. So the decision that we took today to raise by 25 basis points our three interest rates was a unanimous decision, without reservations. We did not discuss or debate any other alternative proposal, and the one that was predicated on the Eurosystem staff projections and the recommendations of our chief economist was unanimously endorsed. No discussion of others. Our reaction function has been very steady, repeated over the course of time, and I hope I will not offend you by repeating yet again that given the level of uncertainty that we are facing, we will decide on a meeting-by-meeting basis. We will be data-dependent. There will be no preset rate path in our considerations. And as a result of that, it will be what it will be. Now, this is not much by way of forward guidance, but as you know, under the present circumstances, there is no such justification for the decision that we are making and that we will make in the future. I think I would add one thing, because I've read here and there that, oh, the ECB will make an insurance decision. It will be an insurance matter. It will be a preemptive rate decision. It's not at all the way we had our discussion, really. Our discussion were predicated on, obviously, the major energy shock that we have observed since the beginning of March, that is enduring longer than what was expected by geopolitical experts, and which we're beginning to see broadening throughout the economy, with direct cost being obvious, with indirect cost also showing up. And as I said, we will be monitoring attentively any further consequences of this major energy shock. Second response in relation to this insurance allegation of ours, which it was not. We have updated our scenarios, but if you remember from last time around, we had two scenarios which we published. We will be publishing a third scenario that will be available on our website, which we have decided to call the milder scenario. So, staff from the Eurosystem has worked on the update of the adverse and the severe scenarios, but they have also worked on a milder scenario in order to be on both sides of the baseline. And the decision that we took today to increase by 25 basis points all our interest rates is robust across the three scenarios. The two updated adverse and severe, but also the milder scenario, which obviously is more positive and something that we should not neglect, but which is at this point in time unlikely to materialize. But we still thought that it was our duty to look at both sides. And on all accounts, our decision stands. And if we were not taking that very obvious monetary policy decision, then at the end of the medium term that we look out for projection purposes, we would be north of our target. So I hope I have covered your question.
Next question to Annette Weisbach of CNBC. Annette, please.
Thank you very much. Madame Lagarde, I have two questions, obviously. I would like to ask you about the recent uptick in core inflation. We've seen that service prices are on the rise. So is that, in your opinion, already a sign that we're seeing first signs of second-round effects? And then my second question would be, where are we in between all these scenarios? Are we closer in the adverse camp? Are we approaching the severe camp? What's the opinion of the ECB? Thank you very much.
Well, on the services inflation, as you will have seen, it has moved from 3% to 3.5%, which is a significant increase. Now, obviously, what we need to understand better is what is under the skin of that increase and how we can distinguish between what is, the direct and indirect consequence of the energy prices' significant increase, or whether there is something else. At this point in time, we cannot yet say whether this service prices' significant increase is attributable exclusively to direct and indirect. What we are confident in, though, is that we are not seeing yet second-round effect, which would be largely attributable to wages, which play a significant contribution in the production of services. But I'm saying again that we will be monitoring closely all that in the months to come. Now, you ask me where we stand, and I just want to take you back to a speech that I gave back in March, which I know you've been following. It was my speech to the ECB watchers. And in March at the ECB watchers conference, I distinguished between three different situations, which are an analytical frame in and of itself, if you will. So I'm not going to consider that one is exactly scenario X, Y, or Z. But I said, first of all, if the shock is limited and short-lived, it's a case where we see through. Now, obviously, we do not find ourselves in this situation because we have decided, and we think that it's a monetary policy that stands firmly on its own and that is robust across all scenarios, but we are not in that sort of let's see through, is going to be short-lived and small. The second situation that I referred to is the situation where the shock produces a large, though not too persistent, overshoot, in which case a measured adjustment of policy is needed. Okay? The third case that I referred to in that ECB watcher's speech is the situation where we expect inflation to deviate significantly and durably from target, in which case the response must be appropriately forceful. So I leave it to you to decide which of the three. I've already eliminated case number one, which is clearly not a situation where it's short-lived and rather small. This is not the case. The decision we've made is not a forceful decision either, right? 25 basis points is a decision which clearly is a signal and is necessary given the economic situation that we have, given the uncertainty that we are navigating, given the inflation outlook that we have and the projections that have been produced by the Eurosystem staff.
Next question, Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thanks very much. On the sort of measured adjustment that you might be doing, does the neutral range?
That's what I said. You concluded that.
But does the neutral range play a role in your thinking in that regard? Is 2.5% for the deposit rate an important threshold, or could a measured adjustment also mean a slight step into a restrictive territory? And then secondly, so before today, there were quite a few economists who've warned that a rate hike in the current environment would be a mistake. Did you reflect on these comments, and what's your response to this?
So, to the risk of disappointing you, we have not discussed the neutral rate nor the range of neutral rate. As you know, there is a lot of work that has been done by staff in that respect, which have given a range within which the neutral rate would be located. Philip Lane has discussed that extensively in a speech recently, but we have not debated that our positioning with reference to the neutral rate, which I remind you is a bit difficult to actually assess precisely because we are not in a situation where there are no shocks, which is typically what you need to have as sort of a environment within which you determine where you are neutral, because you don't stimulate, you don't restrict. So this was not debated at all by the Governing Council. So, you know, everybody has to do what they have to do. Our job is price stability. And our job is to apply the strategic review principles that we have agreed. Our job is to follow carefully the reaction function that you are all familiar with and that we try to be as transparent about as possible so that we are predictable. And in the face of that, frankly, given the numbers we have, given the inflation outlook, given the risk to the upside on inflation, given the robustness of the decision against and across all scenarios, the bad one, the very bad one, and the not so bad one, and the fact that it holds in all circumstances. And if you add to that the fact that our growth forecast as revised is 0.8%, you know, minus 0.1 relative to March, and 1.2 next year, and 1.5 the following year. It's not as if we are in an environment where growth is absent or under significant threat. A lot more can be done by structural reforms, by encouraging a European market that has no obstacles to trade, a saving and investment union, and so on and so forth. And we encourage that very strongly in our monetary policy statement. Thank you.
Now, Aude Kersulek of BFM Business. Aude, please.
Thank you for taking my questions. In the last meeting's minutes, some members mentioned the need for the ECB to avoid being perceived as complacent. Could you elaborate on this? I wonder if today's decision is driven by communication or credibility purpose rather than by inflation expectation becoming unanchored. And secondly, your press release states that today's decision is robust across a range of scenarios. Why use this word today? And does it mean that you have a clearer view of where rates are heading? Thank you.
Thank you very much for your two questions. One is, of course, we should not be complacent. I think that's a recurrent principle that we should always apply. As we should apply the principles of being data dependent, being analytical and rigorous about the analysis that we do of all the numbers that we receive. And this is what the Eurosystem staff has done, and this is what will be done going forward by the ECB staff when they produce the next projections. So it's not an issue of complacency. And honestly, you know, I don't like to brag, and I'm not full of vanity, but I would hasten to add that having maintained inflation pretty much at target over the last 12 months, we have not been complacent. We have done our job, and we will continue doing so. So on your second question, the characterization of robustness of the decision is obviously helpful when you do scenarios across the board. So if we had done, you know, severe and adverse scenario, adverse and severe scenario, and then decided it was robust, yeah, of course it is robust. But we decided on purpose to do scenarios on both sides of the baseline. And even in the milder scenario, the 25 basis points cuts is completely warranted and justified. So this is what we've done.
And now Olaf Storbeck of the Financial Times. Olaf, please.
Hi, I have one question on the inflation forecast. What struck my eye when I compared the current baseline with the March adverse scenario, the headline inflation is lower than in the adverse scenario, but the core inflation is higher for 26. Does this mean that kind of spillover effects are already bigger than you anticipated in March, and what are driving them? And my second question is, you clearly said the rate hike isn't an insurance hike. What is it then? Is it the start of a new hiking cycle, or what else? Thanks.
Well, thank you very much for your two questions. So with reference to the baseline, first of all, I have not compared, and we have not gone into the exercise of comparing the baseline with the adverse or the severe scenario at this point in time. We have updated our baseline both on the account of inflation and on the account of growth as well, with the caveat of Ireland, which is a case in point of international companies organizing their business in such a way that it impacts in an interesting way the Irish numbers. But so what we have done is that we've updated the baseline, and I think the best thing that can be done is to compare the adverse scenario prepared for in March with the adverse scenario compared with June. I think that is more relevant than baseline versus last time around adverse. And as I told you in the earlier phase of our discussions today, we are beginning to see a broadening of inflation throughout the economy. And that is obviously in terms of direct effect, but also in terms of indirect effect. Not yet at this point in the front of the second round effects. But we are going to be extremely attentive. And when we see, for instance, that the delivery dates, that the smoothness of supply is beginning to be impaired, obviously we will be attentive to those sort of ancillary indicators that would help us understand where it is heading. One more point, because I did speak about wages earlier. We do include a level of second round effect in our projections, obviously. And the projections that we have for the 3 years, actually 26, 27, 28, all anticipate compensation per employee at 3.2%, which in and of itself, if you compare that with the projection that we have on inflation, justifies the fact that the net income of workers will actually be positive, and would lead to assume that consumption will continue, not only will continue to be the main driver of growth as it is, but will continue to grow probably more than other factors. We see other factors to fuel growth going forward. Now, yes, I did say that it's not an insurance policy interest rates decision, simply because it's a good monetary policy interest rate decision. When you have, the latest reading at 3.2, when you have the inflation outlook over our target, peaking in the end of 26, continuing to be over target throughout most of 27, returning to 2% in the autumn of 27, and being at target in 28, on the basis of, market curves and all the rest of it, it is pretty obvious that we have to make a decision, that it is a sensible monetary policy decision. So I don't need to characterize it as credibility, insurance, or anything else, for that matter. It's a monetary policy decision that stands, and that is, as we say in the monetary policy statement, robust across all scenarios, including the mild one.
Moving to the other side of the room, Marina Ninkovic of the Croatian broadcaster.
Welcome.
Thank you. Hello, I have a question for Madame Lagarde. Croatia is one of the newest members of the Eurozone, yet for many months it continues to experience rather high inflation rate, way above the EU average. What do you have to say to the citizens that are concerned about this? Thank you.
Well, thank you very much to your question. We are, of course, delighted that Croatia is a member of the euro area, and I and all governing council members and members of the executive board are delighted to have the Croatia National Bank, I was going to say former governor, being now a member of the executive board and the new vice president of the ECB. It's a great representation, and it brings, diversity amongst the group, and it's really a blessing that Boris has joined us. But turning to inflation, of course we're concerned about inflation, but we are not just concerned about inflation in one member state or the other, because our job at the ECB is to look at the whole of the euro area. And our concern, as I said earlier on, is that we see the energy price inflation, 10.9% at the moment, broadening throughout the economy, which is why we are making this decision today. Broadening inflation outlook, underlying inflation, all of that point in the direction of having to make a decision of increasing interest rates. So, because our mission, our mandate, is to restore price stability, we make those decisions. And we are driven by that objective, price stability. Thank you.
Next question goes to Klaus-Rainer Jackisch of the German broadcaster HR.
Good afternoon. Mrs. President, given some of the statements of members of the Governing Council previous to this meeting, one could have expected that the projections for the inflation is much higher. Can you give us a little bit of a flavor how serious this inflation crisis is actually, perhaps compared to previous ones? And the second question, as you know, there's already a lot of criticism despite this very moderate rate hike, especially by the unions who fear that growth could be dampened even further. What do you say to them? Thank you very much.
Well, thank you very much. As I said, our mission, our mandate is price stability. We have defined price stability for our strategy review and our purpose of making decisions at 2% in the medium term. When you see inflation picking up in the way it does, broadening throughout the economy, when you see inflation outlook north of that 2% target and only returning to 2% at the end of our projection horizon, when you see risk to the upside, to us, this is inflation that needs to be taken into account and that needs to be addressed. So I don't know, what other governors in whatever publication or interviews you refer to alleged that it would be higher inflation. But we do have inflation that is too high for our citizens, that is too high for the purpose of price stability as well. And we will address that because our commitment is price stability. Your second question was about the risk resulting from this decision. First of all, I would observe that the main risk would be not to take that kind of decision. Because if you let inflation start running out without control, then it becomes a much more difficult situation to bring it back to the level of price stability that we have defined. So the good decision was actually to raise interest rates, to commit and to deliver on price stability so that people will make their investment decision, their employment decision, their wage negotiations decisions in the light of that commitment to restore price stability as we will.
And now Elisa Piazza of Class CNBC Italian broadcaster.
Thank you for taking my question. Well, you do not say anymore in your statement that longer-term inflation expectations remain well anchored. So if you could tell us a little bit more about this change. And then I have another question on another topic, because we know that the ECB has convened banks to discuss the risks associated with the new AI models, such as Mythos. So what actions is the ECB taking on this issue? And do you consider these models to pose a potential systemic risk to the European banking sector? Thank you.
Thank you so much for your two questions. So in terms of inflation expectations, we'll look at three categories of expectations. We look at market-based measures, we look at survey-based measures, and we look at consumers' expectations. And we try to understand exactly where those expectations stand between the short term and the medium term that is relevant for our monetary policy decisions. And what we see at the moment is short-term inflation expectations that have risen on, in all three categories, more so from the consumers because that is typically the case. But when you look at the longer-term expectations, they are broadly anchored at our 2%. And whether you look at, 1 in 1, 5 in 5, 1 in 5, you have the whole category of intervals to look at. And on all those accounts, inflation expectations are broadly anchored. So you asked me about the, I will call it artificial intelligence at large, but it's clearly the most recent development of artificial intelligence, whether it's by Anthropic or by OpenAI or by other major developers and investors in artificial intelligence, or whether it's from other countries, we are seeing significantly new, faster, more intrusive developments. That is a fact. We also know that these developments are here to stay, and that there will continue to be more in the coming months and probably on an ongoing basis. So that calls for, two categories of responses. One that addresses our own central bank. Are we at the ECB and other national central banks around in the Euro system well equipped to actually resist potential intrusion, potential hacking, potential negative intrusion that would be using those tools? And this is work that is underway, and this is one that we take very seriously, because obviously we are a central part of the financial world. The second, which is more under the remit of the SSM, has to do with how we help flag, call the attention of all the banks that we supervise to make sure that they too, and I know that they do, but that they too pay particular attention in order to protect themselves and make sure that possible intrusion that operate at a fast pace are not going to hurt them. So I think everybody is looking at this very carefully. We do not all have access to the latest the latest tools, of some of those developers that I have mentioned, but there are ways, not necessarily using the ultimate state-of-the-art and latest version, but there are ways to actually protect ourselves, do the necessary patching, and make sure that we are as secure as possible. So this is all of that is taking place. So that's one category. I think there is another category that is, worth discussing, which has to do with how governments, how sovereigns actually respond to these risks, of which I think we are seeing maybe the top of the iceberg, and for which more significant risk should be anticipated, and possibly joint framework, joint governance should be discussed at a higher level. But for the moment, at our limited level as a central bank, we do what we can in response to these developments that are here to stay. Thank you.
Last question today goes to Arturo Lopo of the Spanish broadcaster RTVE. Arturo, please.
Thank you for taking my question. Mrs. Lagarde, what would you need to happen to make today's rate hike decision to reverse? What if under these current circumstances of massive uncertainty, how much time do the ECB or the Governing Council would need to discuss or to consider reversing this rate hike? And as a second question, in this case, you have talked about this is not an insurance rate hike. This is not a cycle. This is not the beginning of a cycle. But at the same time, which are the other components that could play a bigger role on pushing up the floor of the interest rates in the Eurozone? Which is the future good place to be that you have been talking about in the future? The previous 2%, which is the new, under these circumstances, which is the new 2% in the interest rates here in the Eurozone? Thank you.
If you look at our monetary policy statement, we say very specifically that with this 25 basis point increase of interest rates, we are well positioned to navigate the uncertainty and the developments going forward. So that stands very clearly in the MPS. As to the rest, we will be deciding meeting by meeting. We will be data dependent. We will have no preset predetermined rate path going forward. And that's the way we will be operating. Thank you.
Thank you very much. That closes our press conference. We will be back here on the 23rd of July. And until then, all the best and have a good afternoon.
All right, that was ECB President Christine Lagarde in Frankfurt. This is Bloomberg Open Interest. I'm Matt Miller in New York. Let's get a check on markets. On an important day for the U.S., we have gains on the S&P futures, gains on NASDAQ futures, the Dow Jones Industrial Average adding some as well as we get ready to add the world's largest IPO. Stocks to watch today as big tech rebounds. President Trump vows more attacks on Iran and investors gear up for the SpaceX IPO. We have Intel jumping on a double upgrade from Bank America. Oracle is one of the few tech stocks in the red after reporting a boost in AI spending for the year, so higher costs. And you can see NVIDIA, the biggest company in the world, holding it up a little bit, gaining 0.6% in the pre-market. Let's discuss all this with Bloomberg Intelligence Head of Global Tech Research, Mandeep Singh. Mandeep, I mean, there is so much going on in your universe right now. This feels like the culmination, right? Is the SpaceX IPO going to mark a top?
Well, I mean, the way I look at it is right now you've got technologies that are building on top of one another. The reason why orbital data centers are being discussed is because we need a lot of compute. You know, there are estimates around 250 gigawatts of compute, almost $10 trillion in spending. So that's where, you know, the constraints is what's really causing excitement around space data centers. And that's where, this is a big computing shift. When you think about, the 3-4 big shifts that we have already seen in the past 50 years, this could be even bigger than that. So from that perspective, it's hard to wrap around your head around how big that opportunity would be and who are the companies that are exposed to that trend and what kind of growth runway they may have. I mean,
well, and how much it's going to cost to finance that opportunity, right? I mean, we see Oracle shares down because it's costing more than investors are expecting. And I noticed that their cloud revenue grew by 93%, so it almost doubled, but only to $5.8 billion. I mean, if they keep that up next year, they're only going to have 25, maybe 30 billion in cloud revenue, and they're spending how much to build it out?
Well, all these companies are raising their capex. In fact, we are already talking about $1 trillion plus in capex from the hyperscalers alone. And now, with SpaceX, look at what they have done with their terrestrial data center capacity. They've rented it out to Anthropic and Google, and now they have added $25 billion in annual revenue run rate just by renting out the compute. That just goes to show what kind of shortage and environment we are in when it comes to computing capacity, just raw compute.
But they lose, Mandeep, they lose as much money as they make in revenue. I mean, it's not like they have a little margin or no margin at all. It's 100% negative, and their loss is going to continue to grow.
Well, after you add this $25 billion run rate from these two deals, it will be margin accretive. So I think margins will improve. They were losing money. And look, that's where you have to kind of say they got it right in terms of investing first in the terrestrial data centers, because if they didn't have Colossus 1 and 2, this $25 billion line would have not shown. And yes, they want to spend more on orbital data center capacity. And that is where you could ask that monetization question, where they may have to invest more upfront before the dollars show up. But at the same time, I still think, the margin profile is going to improve. And it's investors like to see growth. That's what they want to see when it comes to this build out and, the new technology shift that we are talking about. And SpaceX has pivoted quite nicely in terms of saying, oh, our revenues are 5-7 years out versus, okay, next year we'll be doing $50 billion in revenue now compared to what is in the prospectus, which is $18 billion. All
right, just quickly, what year will it be when they have an annual net profit?
Well, what we saw with Uber or, some of these IPOs which were very negative when they IPO'd, it took them 3 to 4 years. So I would say within the next 3 to 4 years, they should be able to have some sort of profitable metric around non-GAAP numbers that they have given.
But actually make money, like bottom line, like are they going to bring home the cash?
You want them to buy stock and,
Mandeep, we're going to continue to talk to you. Obviously, it's going to be a very busy day for you. SpaceX obviously going to price the IPO this afternoon and start trading tomorrow. Bloomberg Intelligence head of global tech coverage, Mandeep Singh, will be along for the ride. Now, this IPO has attracted more than $70 billion in orders from retail investors alone, according to people familiar. Let's discuss with Bloomberg IPO reporter Bailey Lipschultz. And Bailey, you've been on the IPO beat for many years, including during the meme stock era when, Wall Street bets would buy anything that went public. And have you ever seen a number like that, $70 billion in orders?
No. And it's never been to the scale of potential allocation. We were talking, even if they come in at 20, 30% of this IPO, you're still talking potentially more money going to retail in this IPO than almost every other IPO has raised in totality. So these are staggering numbers. The interesting thing to keep an eye on, though, retail not only is not price setters, they are price takers. The big question has been, what happens when the stock opens tomorrow? Will retail have the capacity to keep buying? And is that something that can bridge the gap from IPO to NASDAQ 100 entry? That's 15 trading days that we don't know what will play out.
So that's a 3-week gap until we get, how much guaranteed buying power is that? Like $10 billion coming in with the NASDAQ 100 and the FTSE Russell indexes?
Yeah, it's pretty strong. It's obviously not what could have been at play if the S&P 500 had a fast track.
That would have been 40 to 50 billion.
And that would have been big. Granted, that would have taken 6 months to play out. But this is going to be some pretty big passive money flowing. And the interesting thing to also keep an eye on is we're going to have levered ETFs around SpaceX, single stock levered ETFs trading shortly after the IPO. So that's going to be something that'll create flow into the stock, as well as kind of that net buying from the NASDAQ 100 buying the Qs are also buying some of those levered ETFs.
Bloomberg 500 going to include SpaceX right away? Does the B500 get that in the index?
You asked me this last time, man. I honestly don't.
I thought you would have looked it up since last time.
I did Google it. They're different. It's different than the S&P 500.
You don't have to Google it. You work at this company.
You work here too.
All right, Bloomberg's Bailey Lipschultz talking to us about the SpaceX IPO. We're going to continue. Obviously, this day and really this era is all about two things: tech stocks and the war in Iran. We're going to cover that all with Bruce Richards, the CEO of Marathon Asset Management. He's going to join us in the next hour. He says SpaceX is the biggest rising star of all time, the GOAT. We're going to talk to him about SpaceX from a credit perspective. But back to the war in Iran, President Trump threatening more attacks in a Truth Social post. He said the U.S. will hit Iran, quote, very hard tonight and take control of a key Iranian oil hub, much like we have with Venezuela. The president spoke at the White House yesterday.
We hit them hard yesterday, and we're going to hit them again hard today, in case you miss it, in case you don't turn on your television set. And we'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers because, you know what? They dealt with some very stupid presidents.
Joining us now is Bloomberg Washington correspondent Tyler Kendall. And Tyler, what sense do you get listening to the president that he wants to achieve with these attacks? Does he still want some kind of deal?
Well, Matt, at this point, what we're hearing from the administration is that the escalation in both the strikes and now these renewed threats that we got this morning are geared towards trying to force Iran to make concessions when it comes to the negotiating table. Though in an interview with Fox News moments ago, President Trump said that his patience is ultimately wearing thin. And that's part of why we're starting to see some of this rhetoric come out from the White House, including saying that we could take Karg Island. Now, of course, that in and of itself is raising its own political risks and stakes, as it has these major questions here about whether or not that would involve putting U.S. forces on the ground. President Trump did say that he doesn't want to have, quote, boots on the ground, and we've heard U.S. officials previously float that maintaining air superiority could mitigate that risk. But he went on to add, in part, quote, if I wanted to, we could put a small group of soldiers and take over the whole place. Keep in mind, the U.S. did strike Karg Island back in March, but ultimately opted against hitting Iranian energy infrastructure on Karg Island and instead geared it towards those military assets. So as we watch for what will happen later tonight, as President Trump vows that it will be more powerful than we saw overnight, we are going to have to see what those targets include and whether the U.S. sticks with the path of military targets or chooses what could be some serious escalation.
It doesn't seem, Tyler, as though the oil markets are terribly concerned about a resumption of all-out war. We see NYMEX crude down to under $90, $89.24. Brent is off about $1 right now to $92.21. What did we learn yesterday from the president in terms of how much oil is flowing through the Strait of Hormuz?
Well, according to President Trump, the U.S. has so far helped to escort nearly 200 ships since the ceasefire began, which he says had more than 100 million barrels of oil on board. We're still waiting for some more formal verification on that. We do know that more flows have been going through as we see some Middle East exporters start to open up their exports to Asian markets, which we hadn't seen since the start of the conflict in the last week. But with that said, there are still significant risks here, of course, to commercial shipping, as we heard from the IRGC overnight, that they are going to tighten their grip and close it off to all commercial vessels. CENTCOM did come out with a statement saying that that is not true and that the U.S. is still helping to ensure there is some sort of freedom of navigation. But, Matt, I would also put on your radar that as the U.S. threatens to hit energy in terms of Karg Island, we could see Iran really respond by retaliating and hitting maybe Gulf state energy sites, as we've seen before, but also renew the risk that maybe we could see Iran proxies utilize their power when it comes to the Red Sea. Earlier this week, the Iranian-backed militant group, the Houthis in Yemen, said that they were banning all Israeli cargo ships from going through that corridor. They didn't extend that threat to all commercial shipping, but it does, of course, just raise the risk even more when it comes to the strait.
Tyler, thanks very much. Bloomberg's Tyler Kendall reporting from Washington. Now, a quick check of what's going on in the markets. 20 minutes after the opening bell, you have the S&P 500. This is the cash trade, obviously. The ECB kind of threw me off a little bit. Up 0.5%, 73.05. NASDAQ 100 gaining more than 1%, 28,827. And Brent crude down 1% or 89 cents to 92.22. Joining me now here in the studio, Franklin Templeton, Senior Investment Strategist, Katrina Dudley. Katrina, thanks so much for coming on. Let me just get your take on what we've seen happen over the past few days, because Friday we had a massive sell-off in tech stocks, right? 4.8% on the NASDAQ, and this week has been choppy.
This week's been choppy because people are talking about the returns on AI. And I think that's really been the narrative. If we look at the narrative earlier, it was where are people spending and what is the CapEx spending? And now we've got this focus on where can we actually generate money and where can we actually start to earn profits? And I think you were asking about, on the SpaceX IPO, when are we going to see profitability? I think that it will be longer tailed because a number of these capital investments are by their very nature long-term investments. So the returns will be in the future. And I'm just not sure we're kind of used to that yet as a market.
Well, certainly not for a company that's valued at $2 trillion, right? I mean, it's odd or unusual to have a company that's losing, more money than it makes in revenue get an investment-grade credit rating.
I think we were talking about that just earlier, the fact that it's raised, the $20 billion of debt, and it's got it at 4% interest rates, which is phenomenal. I think that there's two things that really differentiate this, and I'd love to think it through, is that, number one, they're deploying tangible, real assets. If we look at some of the other, people have been talking and likening things to the internet. When we were looking at the internet, they were creating intangible assets. They were creating networks, and those things were, harder to touch, harder to feel. SpaceX is putting real things up into space, and so people really like that backing aspect of it, which is what I think is driving that investment grade, the investment grade rating. And then the second thing, if I go back time and time again, and probably we have to go way back in history, look at the railroad boom, for example. These companies were not making money for long periods of time, but they were putting infrastructure in the ground, and that infrastructure continues to serve us today.
It makes sense, and Halo investments are all the rage right now, right? Hard assets, low obsolescence. I wonder about, though, the costs, the CapEx, especially if these are depreciating assets. How do you feel about investor reaction to Oracle, for example, is negative after they find out it spent more money than it was supposed to?
I think when you look at the spending more money, people are just making sure that the investments are rational. Because the fact is there's such long tail in the returns, people are actually challenging the upfront numbers a lot more today than I think in their past. And I do actually think that's a healthy sign of the market, that it's, we'd had this idea that, probably a year ago, if you just said I'm spending on AI and I'm spending CapEx on AI, the stock would go up. Now, the narrative is if you're spending, please give us the return criteria. Talk to us why you're spending this money and how we as investors should look at the KPIs and judge the returns on that. Because as investors, we're a little unsure, and we're asking to be kind of let under the hood and give us a couple of those metrics so that we can get comfortable as investors that you're making a right decision. I think, though, we also need to balance this out. In all of history, you have had situations, and I don't think this will be different, where people do make capital investments that don't make the returns. We just have to be prepared for that and make sure that you're invested in the companies that are not doing those type of uneconomic investments, or at least have buffered them or kind of sandboxed them in some ways.
How much do rates matter? I mean, we just had the ECB, and obviously that's a totally different ballgame than the Fed. But we do see the 10-year at 4.5%, the long bond at 5%, at a time when inflation, the PPI number came out at 6.5% today.
I know, and I think it is the kind of combination of what is inflation expectations versus what is short-term print. And I think expectations are significantly lower. People are talking about this as being kind of a temporary blip. Now, I would say I was, probably a couple of months ago, I thought that this was going to be much more of a temporary blip on the, inflation side and on the oil price side attached to the war in Iraq. That has obviously extended longer than than expected. But interestingly, oil prices have come down off those highs. So the inflation that's coming out of energy prices is starting to taper. We still do have the housing price inflation, but that market started to slow down. You've seen a little bit of stability there. So we've not necessarily got as much of an inflation tailwind there on the consumer. But I do think we are continuing to be very cautious on the inflation narrative. And I think that is going to hamstring the Fed. But don't forget, our Fed is a dual mandate, so they need to ensure full employment. And with AI and people talking about AI being a jobs replacement technology, I think that they're also...
That hasn't shown up in the jobs market. Look at the last non-farm payrolls number. It was a blockbuster.
Exactly, because the fact is that what's happening is that people who are seeing parts of their jobs replaced by AI are actually repurposing themselves and actually making themselves even more valuable using AI to help senior executives. That's what we just saw with a whole lot of our administrative assistants. That some of the work that they're doing, which was no joy work, as I call it, they're taking that time and actually making themselves more productive. And I think that that's the surprise that we've seen on the jobs narrative.
Katrina, great having you in today. Thanks very much for joining us. Katrina Dudley there, Senior Investment Strategist over at Franklin Templeton. Coming up in the next hour, Marathon's Bruce Richards on SpaceX and opportunity in credit markets. Plus, we'll talk data center real estate with DigitalBridge CEO Marc Ganzi. They have leaned heavily into data center real estate and now are one of the biggest owners in the country. In terms of what's going on in the markets right now, just about a half hour into the session, we're seeing gains on the S&P 500, 73.25 right now. The NASDAQ at 28,960, up 1.6% as we await the SpaceX IPO pricing. This is Bloomberg Open Interest. We are 30 minutes into the trading session. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment at Super Return in Berlin. Coming up, President Trump threatens more attacks on Iran. He says the U.S. will hit Iran very hard tonight. Meanwhile, Oracle's latest forecast is raising fresh questions about the profitability of the AI infrastructure boom, and investor demand for SpaceX appears sky high, attracting more than $70 billion in orders from retail investors alone. That IPO set to price this afternoon and begin trading shares tomorrow on the equity side. But the company has already hit a home run on the debt side. SpaceX has reportedly lined up investment-grade ratings from 3 major bond ratings firms, underscoring the growing confidence in its credit profile. In fact, Marathon Asset Management CEO Bruce Richards says this rising star is the GOAT after SpaceX refinanced $17.5 billion of debt, some of which had cost more than 12% to service, with a $20 billion facility that cost somewhere in the mid-4s. I'm pleased to say Bruce joins me at the desk now, and this is fascinating, Bruce. You know, I love the term rising star and fallen angels, but this must be, is it the biggest rising star of all time?
Of all time, because, you know, first of all, SpaceX is the biggest rising star of all time. You see what's happening in the equity market, you know, pricing a $1.77 billion IPO, the biggest IPO ever being 2012 when Facebook came to market with $104 billion. And so it just is an order of magnitudes greater than anything we've seen. In the credit markets, $17.5 billion, as recently as last year, pricing a 12.5% coupon last June. And here they are taking the full debt stack, 10, 11, 12% coupons, you know, repricing it down to a 460, the 10-year note today being a 453. So, you know, it's definitely an IG rating because when you look at $20 billion of debt that they just priced in a 460, and rising star is a term that we use when a non-IG or high-yield issuer, and they weren't rated non-IG by the rating agencies that were non-rated, but they had 10, 11, 12% coupons that are now a 4.6% coupon. So they reissued, as you said, $20 billion to refinance the $17.5 billion outstanding. And when you think about a market cap of 1.77 trillion, or call it rounded up, end of trading day tomorrow, say 2 trillion, and only $20 billion of debt, that's only 1% of the entire enterprise value is in debt. In fact, with all the cash that they have, which will be in excess of $80 billion of cash, they have no net debt.
Right.
So it's clearly an IG-rated company as we stand today.
No net debt now.
As the markets view it.
I have to ask, Bruce, I mean, you're one of the most well-traveled, well-connected guys in the credit industry. What are you hearing about their plans to raise further debt capital?
Well, certainly they'll have capital needs, and they'll use the debt markets to tap into those capital needs, as companies obviously do that. And so for SpaceX to have $30 billion or $50 billion of debt is completely within the realm of a strong BBB credit.
At a $2 trillion equity market capitalization, it really is nothing.
And with the cash flow they're going to generate as a business, and you see what they've done with their data centers as of recent, and all the cash flow is going to be gushing, and the returns that they're making off of that investment. And so the company's very well positioned across the board.
What metrics do you look for? Because I was just talking to Mandeep Singh from Bloomberg Intelligence about the fact that they're not going to make any money for many years, right? I mean, in terms of the actual bottom line net income, they're still going to be generating losses because they'll invest so much in this infrastructure.
They're going to be reinvesting back in the business.
But what are the most important metrics for you as a credit investor?
There's many different metrics that you want to look at. First is enterprise value relative to debt. Second is, the cash flow that the company, from a revenue standpoint, is generating. And third is what their burn is, and how sustainable that is, given the revenue growth. And so revenue growth is going to be the big story for SpaceX for years to come. We saw with other companies that, like an Amazon, for instance, how many years it took to really, deliver that escape velocity where they're just gushing cash flow. SpaceX will continue to invest in their business, both in space, in communications, in technology, within the XIA sector of the LLMs and building out the data centers. And the next for them will obviously be data centers in space.
They're not the only ones investing, tens of billions, hundreds of billions of dollars in data centers, and one of the big costs is chips. What do you make of the Michael Burry argument that these are depreciating assets? If you spend $100 billion on these in 5 years, they're going to be worth 10.
Yeah, well, FASB tells you in the Standard Board for accounting tells you that you depreciate a chip over the course of 6 years. So whatever you spend on it, it's 1/6 a year, and so 3 years later, it's worth 50 cents and 18 cents in that final year before it's worth 0. And that's the straight line depreciation schedule for a chip. Now, what we do know about a chip is the degradation is 0. That is, the chip that you bought 10 years ago or 20 years ago, the silicone does not degrade, and the chip it can do exactly what it did 10 or 20 years ago. And so the demand for chips is going to be off the charts for these H100s, and when the Rubins are out, the GB200s for inference. And so Michael Burry is completely wrong in his assessment that the chips are
worthless.
They're saying they're worthless.
Or worth less, I should say.
Worthless or worthless after 6 years, because it's simply not the case. Look at the H100s from years ago and the values, and you look at the inflation of chips and the demand for inference that's going to come next, and what you're going to see is the chip values are going to hold in a lot better than this depreciation schedule that most underwrite to.
What do you make of the market mechanics of this IPO taking $80 billion out? OpenAI and Anthropic will take large numbers out of the market.
Well, there's big rotation happening in equity markets as retail and institutions, free up their book to buy, the $75 billion of SpaceX, which might be flexed up to $80 billion, given a little additional issuance that might happen. But
green shoe
option, and so you'll see that rotation happen, and so. that creates a supply dynamic, a heavy overhang for some of the other stocks that are being sold, but the fundamentals in the stock market are quite good. You just look at earnings and what they're rotating out of, and so it creates a buy opportunity, I think, for some of these other stocks that have been sold to make room for SpaceX. You see the same crowding out or the same rotation happening within the global credit markets. And so some of the best investments, Matt, some of the best investments are when you have a hyperscaler that issues off balance sheet to finance their AI build out, and you're able to invest in the structure or do some of the leasing on some of that, the hard assets to facilitate that build out, and the returns that we're making on the debt side. And as a result of this rotation, people selling down bonds to make room for all of the heavy issuance by the Oracles or by the Metas or OpenAI or Anthropic or SpaceX, XAI, that's occurred over these last couple of years is a wonderful investment opportunity. And so I think money finds its best risk reward, and there's tremendous risk reward that comes out of it. To build a gigawatt, it requires 500 acres of land. You have to build the box. That's around $4 billion spend. But what goes in the box for a gigawatt costs around $46 billion.
Yep.
That's the GP200s, 300s. It's the racking system, the wiring systems, the water cooling systems, the transformers and the turbines, and everything it takes to power a gigawatt plant costs around $46 billion. So total cost for a gigawatt is around $50 billion. The inefficient builders build it for $60 billion. And the most efficient builders, like an Elon Musk, build it for much less than that.
Although I wonder how much it's going to cost when you build that in space, right?
Much less, because you don't need the land, you don't need the metal box, the data center, you don't need the cooling systems, and so you have a huge, and power, the biggest cost of it all, you have a trillion, more than a trillion amount of the power coming from sun that you have versus all the power on planet Earth. And so when you look at the cost savings to do it in space, it's transformative.
Okay,
and
that's
plus,
the most interesting part of this whole...
And plus, you don't have the communities that are NIMBY. that complain about, about whether you're on-grid or off-grid and having a power plant that's closer to, a community. And so you do away with all that issue by putting it in space, and there's only one company in the world that can pull that off.
SpaceX.
SpaceX.
Bruce, you're going to stick with us. What a fascinating take on this story. Bruce Richards from Marathon Asset Management stays with us. We have some breaking news on the Supreme Court right now. Let's get to Washington, D.C., because Wall Street is watching Washington closely now. Tyler Kendall, our Washington correspondent, has the details of this recent opinion. Tyler?
Yeah, hey, Matt. So the Supreme Court has shielded funds from some investor lawsuits, essentially ruling that an 85-year-old federal statute doesn't authorize shareholders to sue over bylaws and management decisions. This ruling from the court came down 6-3, blocking activist investors from suing 11 closed-door funds. That includes some affiliated with FS Credit Opportunities Corp and BlackRock. Now, the suing investors were led by Saba Capital, run by hedge fund manager Boaz Weinstein. And at the heart of this was whether investors could basically sue funds over any management decisions under what's known as the Investment Company Act of 1940. Saba was challenging a move by FS Credit Opportunities Corp that would make it harder for activist investors to essentially gain a foothold, since the fund was using a state law to allow controlling shareholders the right to block other investors from acquiring a more than 10% voting share. Matt, despite this decision, experts do say that this won't entirely strip activist investors of tools to sway how funds operate through voting or other means, but it was definitely one that we are watching closely, since we actually know that this is a ruling that favors the Trump administration's view and how the SEC operates moving forward.
All right, Tyler, thanks very much. Bloomberg Washington correspondent Tyler Kendall talking about the Supreme Court. You can type NI space SUP go on your Bloomberg terminal to get more on that story. Let's take a look at what's going on in the equity indexes right now. The S&P 500 is rebounding a bit, up 0.4% to 7296. The NASDAQ up 1.2% as tech stocks rally harder to 28,852. Yields are coming down, which is helpful, as well as oil, also a tailwind for stocks. get a look at some of the single stock stories we're following for you. Oracle shares are taking a hit after the company reported higher than expected CapEx driven by data center spending. That raises concerns about the profitability of this investment. You can see the shares are down more than 11%, although they have been on a tear, I think up 35% year to date. Shares of chip makers and other AI-related companies rising following those Oracle results. Nonetheless, NVIDIA up more than 1% as a $5 trillion company that moves markets. Micron and SanDisk continue their march upwards. Morgan Stanley says memory stocks can move even higher after the necessary correction that we watched in the last week. SpaceX-linked stocks are rebounding ahead of the highly anticipated IPO, the largest in the history of the universe, as far as we know. Will start trading tomorrow. Coming up, we're going to get more with Marathon Asset Management CEO Bruce Richards. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Apollo is now screening every software deal for AI disruption risk. The firm built a framework ranking software sectors by how vulnerable they are to AI and has already reviewed its existing portfolio. Apollo says teams that move quickly and invest in AI adaptation will be best positioned to survive what it calls a major technology platform shift. The FIFA World Cup kicks off today in Mexico City, and 1.2 million fans are poised to descend on the New York area starting this weekend, creating major transit and traffic headaches. Officials are urging commuters to use public transportation as Penn Station, New Jersey Transit, and New York City Subway, the New York City subway system in general, brace for heavy crowds, road closures, and delays around the MetLife Stadium throughout the tournament. The Knicks are now one win away from their first NBA title in 53 years after pulling off the biggest comeback in finals history. Down 29 in the third quarter, New York stunned the Spurs 107-106 as O.J. Anunoby delivered the game-saving block and a buzzer tip-in gave the Knicks a 3-1 series lead. Bruce Richards, Marathon Asset Management Chairman and CEO, still with us, born in Brooklyn, Knicks fan your whole life. Did you watch the game yesterday?
I watched it, and, you know, I started the second half tucked into bed, you know, looking for a very solemn evening. And by the start of the fourth quarter, here I am in my jammies, in front of TV, standing on my tippy toes, watching every minute of that fourth quarter in disbelief. The greatest comeback in Knicks history.
So awesome.
The greatest game in Knicks history. Down by 29 points with less than 10 minutes to go in the third quarter to win that game, the way they won that game in the NBA Finals is the greatest NBA final game, I believe, in the history of the NBA.
At the Garden, I mean, this is why we love sports.
Yeah.
So great that the Knicks are doing so well, and the only problem is this will totally overshadow the World Cup. I mean, soccer is already
I know you're a big soccer fan.
Deadly boring, but compared to that, I mean,
nothing compares to that.
You could definitely put on your jammies and go to sleep watching a soccer game. Let me get to something else that's been fascinating lately, and that is inflation as it continues to creep higher. Yesterday we got CPI out, I think 4.2%. Today we got PPI at 6.5%. Does this worry you?
You know, it is worrisome, but it's all tied to energy prices. Energy prices year over year, or are up 50-60%, and so a lot of the energy is feeding in, and the knock-on from energy, and ex-energy. Look at CPI yesterday. The core, up 2.5%, and so yes, I'm concerned with inflation. Absolutely, yes, it's bearish for bonds. Bonds are holding in right now, but yes, it's bearish for bonds. We'll see what Kevin Walsh has to say next week. But the ECB, I think, Christine Lagarde made a policy error today, and they'll make another policy error the next time they meet by raising rates, because they raised rates today.
Why are they doing that, by the way? Because it's clear that raising rates doesn't bring any more oil out of the ground, right?
It will not bring in, and so the only reason to raise rates is to damper demand, and they don't have a demand issue, they have a supply issue with oil, and that's what's causing the feed-through in inflation in Europe. But Europe has a lot less inflation than inflation we've seen, A. B, the real problem in Europe is this past quarter, GDP contracted 0.2%, Matt. And so how do you raise rates into a contracting economy, to me, is a policy error. Central banks make policy errors all the time. This is one of them. And so projecting for next week, Kevin Warsh, it'll be his first, we'll be talking about this next week, and you'll be focused on this next week, I'm sure. Yep. His first Fed meeting and what he has to say. But I'll give you a little preview into what he's going to say. He's going to look at other inflation metrics, look through these inflationary numbers, believe that X energy, which they can do nothing to control, inflation is actually better behaved than what the markets believe. And so we're going to be in a holding pattern for a while. The markets are pricing in by next spring one Fed tightening. I believe the markets would swung from an easing to a tightening. We're wrong then, I'm wrong now. The Fed is on hold for the next year. So that means slightly higher rates in terms of treasuries and SOFR for a bit longer. It's going to be a little worrisome for certain industries that, like housing, that rely on lower rates. It'll be a little worrisome for jet fuel prices and airlines. But for the rest of the economy is doing just fine. We're not Europe at 0.2% negative. We're probably tracking around 2.5% to 3% positive at this point over the next year.
And that's real growth.
And that's real growth. And so inflation, isn't necessarily negative for equities. It probably feeds through to earnings a little bit, while it is negative for treasuries and fixed income. What we see is it's not hurting credit. Because you look at the IG spreads, they're really tight, 75 basis points for IG corporate credit, and high yield holding in right around 300 basis points off of treasuries or slightly inside of that. So what we're going to see is a dispersion story for credit, where certain companies are not going to benefit from it or be harmed by it, and certain companies are going to sell right through it despite what is slightly higher inflation and slightly higher energy costs.
By the way, Bruce, why are spreads, or how can spreads remain so tight as equity indexes, I know we've come off a little bit, but as equity indexes hit all-time high after all-time high, as so much money goes into SpaceX and OpenAI and Anthropic, where is all this liquidity coming from?
Well, first of all, fundamentals. That's the technical side. The fundamentals are earnings are strong, and so that's supportive of credit, number one. Number two, the economy is strong, and so that is supportive of credit. And so the credit markets are just fine. There's a lot of money in the system globally, and people want to allocate institutions, insurance companies in particular, and the wealth channels want fixed income. And it can't all be equities, and insurance companies are 98%, things that are fixed income like. And so there's a lot of capital that, structurally invest in credit, and it's a big credit market.
They don't want treasuries, right? They're selling off bonds to buy everything else.
Treasuries is what's been volatile. Yeah. And credit has actually been rather stable. So when you look at a high yield bond that yields 7 with a 7% volatility, as opposed to a 3 or 4% treasury that had a 10 or 15% volatility and are down on the calendar year. You look at the BB index for high yield bonds since the beginning of last year, it's up around 12%. And if you look at what's happened to treasuries, treasury prices are lower.
Does the war matter? Because I'm looking over your shoulder here at crude. It continues to come down even as we ramp up attacks in Iran. We're holding well under 100, like $92 a barrel.
Which is remarkable in itself, given the recent onslaught. And but evidently some oil is actually getting through the straits, right? Because the administration, the U.S. administration, has protected the straits, and Iran may not be in position to do anything about it, and that's what I think the administration is playing for. And so you can do it the easy way, you can do it the hard way, but we need oil to flow freely, to Europe, to Asia. We already are independent here in the United States, but there are other ways of energy, transporting around the world. And
we're finding workarounds.
And the Saudis are starting to have a workaround through the Red Sea to stay out, of the strait. And so, there are manipulative moves that are actually very supportive. But we're running low on reserves, and the situation has to be resolved. But for now, it's very, very sustainable, despite the fact that there's been a spike in energy prices year over year.
It's
and
come
the
off,
impact
though.
for PPI and CPI.
I got to ask about, before we leave, the redemption requests that we report on almost daily, the gates that have come down, and the AI story that I was just talking about, with Apollo, trying to see if any of their software investments or how vulnerable they are to AI.
Yeah. So just big picture. So JP Morgan, in their most recent report that was released yesterday, puts the direct lending business here in the United States at $2.1 trillion in size. Just to level set, there's been about $18 billion of redemption requests. 18 billion of redemption. There's 40 billion in redemption requests. 18 billion has exited.
Got it. Okay.
So 18 billion, divided by that's $2.1 trillion is a sliver. It's less than 1%.
Right.
And so while that less than 1% wants out, rightfully so, because a lot of the managers have taken, as you just indicated, taken way too much software exposure within their BDCs, within their open-ended structures. That's problematic. Number one, there's been a complete new revaluation of what a software business is worth. We don't know which one of the software companies are going to make it through in the next 3 to 5 years, and it's too early to tell what the business is actually worth. So how can you decide how much debt can support that company?
But overall, you're not concerned about the redemptions as
so
a
I'm
small,
not. It's not a bug. It's the feature. It's how it was set up.
Yep.
The problem and why retail is leaving these open-ended funds is because the problems of software in their book. And so Apollo's right to call that out. And thank you, Matt.
Thank you, Bruce. I got to wrap you, Bruce Richards. DigitalBridge is betting on the future of AI with its billion-dollar acquisition of power investor ArcLight. DigitalBridge CEO Marc Ganzi says AI is rewiring the global power equation, making electricity one of the biggest constraints on the industry's growth. And I'm pleased to say that Marc joins us now. Marc, first explain to us the details of your acquisition, how you got into it, and what you expect out of it.
Well, Matt, we started in a joint venture with ArcLight about a year ago with a singular purpose around building dedicated power to AI infrastructure, going behind the meter to find solutions for our customers that didn't have to rely on the grid. As you know, we've got a major problem in terms of grid availability capacity against what our customers want. And so when we entered into that joint venture, which was a large strategy, a $5 billion strategy to build grid independent power, what we found in ArcLight was somebody that shared, our sort of strong desire to build and be an industrial builder of infrastructure. And so, after a couple of months into the joint venture, I looked at the founder and CEO Dan Reber and said, "This is going really well." And he said, "Yeah, it's going really well. We should just merge. We should figure out how to do this together." And we did. And so we announced that transaction. And if you think about what's on investors' minds today, Matt, it's really about building power and building compute. And don't take it from Dan Reavers and myself, take it from Jensen himself last week in Taiwan, who said the path to tokenization goes through power. And ultimately, you got to build compute, and you got to have that connected to a lot of dark, dense fiber. And that ability to deliver the ecosystem is now on display at DigitalBridge with the addition of ArcLight and Dan's amazing team.
Marc, you have built really a huge portfolio now of data center assets, and I've noticed at a lot of your campuses you have individualized solutions. You've got a microgrid at one, right? You've got 100% hydropower at another. Does that power equation have to be in place before you'll invest, or do you pick spots purposely to have their independent sources of power?
Well, the good news, Matt, is we've known each other a long time. We started about over 10 years ago building data center campuses. This isn't a new thematic for DigitalBridge. And today, our global total compute availability is about 7.7 gigawatts that's turned on. And we have another 23 gigawatts behind that, Matt, that is connected and ready for service. So it's a global leading portfolio of 32 gigawatts. Nobody has that available power at its discretion to light up for customers. And it puts us in a really unique position when we sit with customers. We have 11 different portfolio companies around the world. totally focused on delivering for customers. And this power bank advantage we have is a strong one. But also, as you said, we got to keep building. We got to keep building grid independent solutions. And at the same time, Matt, we've got to use those to put power back into baseload. We've got to put power back into the U.S. grid. That's a critical obligation that every data center owner has today.
What kind of margins are you making on these acquisitions? There was a lot of concern today around the Oracle earnings because they're spending more than investors had expected. How much are you making back on every dollar that you put in?
Look, we don't get into specific cash-on-cash returns, Matt, but what we are targeting on a levered basis is mid to high teens returns across our strategies today. And ArcLight has a similar philosophy, which is, navigating to those high teens returns. And what I can share with you is that when we bring the compute and we bring the power together, the returns go up. And so that ability to deliver a dedicated power solution for a customer and at the same time provide that massive amounts of dark fiber connectivity, that low latency compute solutions that we bring with all of our fiber companies, it enables us to price those rents at a place that are really attractive. And most importantly, allows us to show up on time for the customer. I can't tell you, Matt, how important it is today to show up for customers and to be on time. That's really critical.
So back in December, you announced, a sale to SoftBank, or they made an acquisition of DigitalBridge assets. How important does being in that portfolio, or how much does that help you deliver that on-time accountability?
Well, look, we're super excited about partnering with SoftBank and Massa's ecosystem. It's really an interesting combination. And then you bring into that perimeter ArcLight and all the power that delivering, you can really begin to see kind of the roadmap of where we're going into the future. And being tethered to that organization is really fascinating. I mean, the things that they're doing are really interesting across AI. And the exposure we get to some of their great CEOs is amazing. And Massa is amazing himself. But we're really excited about the ability to deliver on an ecosystem. I think you're going to continue to hear me say that the uniqueness of power plus compute and plus the stack where you're delivering the actual hardware is really about the future, Matt. And the future is AI factories. I mean, we've been saying it now for a couple of years now around building AI factories and delivering those solutions. And you heard that obviously on display last week with Jensen in Taiwan. The future is the ability to deliver the full stack. And it's not just about delivering infrastructure and power, but it's also the ability to light up the compute at the same time. And so that's the direction of travel. And SoftBank gets that better than anybody. And building super artificial intelligence and looking around corners and heading towards the future is what we're up to today. So the take private of DigitalBridge is really a fantastic step in our evolution. It really frees us up and enables us to do some things that allow us to go back to our roots a little bit. And the founders here at DigitalBridge remain intact. We're a big shareholder and a partner with SoftBank in that take private. And so we're excited. The future is looking really strong for us.
I mean, the demand obviously continues to look convex, right? But I wonder what you think about putting orbital data centers in space. I mean, how does that affect your land-based business?
It doesn't. It's a nice science project. Putting compute into space has a host of challenges. And we look forward to seeing how that plays out. And look, at the end of the day, the capital that we price, Matt, is very different than the capital that Elon prices. And he's a great risk taker. He's a great entrepreneur. And if anyone can put compute into space, it's him. God bless him. We don't have that delivery mechanism. We stay with our feet on the ground. And what I mean by that is the commitments that we've made to our limited partners and the data centers that we build are tethered to 15 and 17-year investment grade contracts. And our ability to access capital has been unprecedented this year. We've been able to access close to almost $40 billion of debt capital across our ecosystem. And ultimately, my job is to stay here on Earth and continue to deliver for customers, Matt. I'll keep my eye towards the stars. Elon's a great customer. He's someone we consider a big friend. And we'll watch with careful eyes on how people put compute into space. Look, at the end of the day, if one of our servers goes down, our response time is immediate. It's on the ground. It's a technician in the data center. And the great thing about owning companies like Switch that have 100% uptime, we've never had 1 minute of interruption at Switch, one of our great portfolio companies. The challenges of putting compute into space, let's put aside for a second, Matt, latency and the ability to communicate between Earth-based applications and AI industrial use cases, what goes wrong if a server goes down, up in space? So a lot of questions to be answered about that. Not the first time we've heard people wanting to put compute into space or compute underwater. That's another one of my favorite ones. Again, my job, keep my feet on the ground, stay here, deliver for customers, and deliver for LPs.
All right, great intel, Marc. Glad we could get you on today. Marc Ganzi, they're the CEO of DigitalBridge. Let's get a check on what's going on in the markets right now. Just about 7 hours until that SpaceX IPO prices, although we generally have an idea at $135 a share. There was no range. We see S&P, the S&P right now up to just over 7,300, a gain of 0.5%, a rebound after a drop yesterday. The same is true of the NASDAQ. It's up 1.2% at 28,836. We have yields and the price of oil coming down, which are a tailwind to stocks into this event. Coming up, how SpaceX trades in its first weeks will ripple across private markets and impact valuation benchmarks for Anthropic and OpenAI. More on what's at stake after this. This is Bloomberg Open Interest.
There you go. Successful hot staging separation. We are not seeing as many booster engines ignite as we expected for boost back.
SpaceX is the biggest rising star of all time. When you think about a market cap of 1.77 trillion, or call it rounded up, end of trading day tomorrow, say 2 trillion, and only $20 billion of debt, that's only 1% of the entire enterprise value is in debt. In fact, with all the cash that they have, which will be in excess of $80 billion of cash, they have no net debt. Right. So it's clearly an IG-rated company as we stand today.
That was Marathon's Bruce Richards speaking with me moments ago. The SpaceX IPO will price today with retail orders alone topping $70 billion. Veteran short seller Jim Chanos, though, is bearish, saying this is really a hopes and dreams IPO. Let's discuss with Bloomberg Tech co-host Ed Ludlow and Bloomberg Chief Wall Street correspondent Sri Natarajan. Hopes and dreams I thought was interesting, and I thought, yeah, well, I mean, he's always been like critical of Tesla as well, and nobody makes money on that short. But he pointed out that Tesla only trades at like 20 times sales, whereas this is going to be 90 times sales. It's just a different level.
Yeah, it's a different level, but like most of the existing investors on the cap table have been there for a very long period of time where, in the 2000s, this was a company valued in the low 100 millions that made rockets and was trying to crack reusability. There is a big gap and disconnect between the thesis on SpaceX and trying to draw parallels with Tesla. I think, what a lot of the investors that are going into this IPO believing, sincerely, genuinely believing, is that SpaceX is a way more diversified business today, right now. We can talk about the blinder it's played on neocloud contracts with Anthropic and OpenAI than Tesla ever was in the first, decade of its life as a public company. And the retail story is, well, Elon Musk is playing the same playbook with Tesla. The retail investor base was a significant part of propping up the valuation based on AI and humanoid robotics. And my understanding is that the reason they'll go high on the retail allocation in SpaceX, same logic.
How high will they go? I mean, I had heard 30%, and that would be almost $23 billion in shares.
It's going to come down to basis points and percentages from 25 to 30%. One way of looking at it is Alibaba raised $21 billion in its IPO, all told. They'll raise near or more than that just from retail investors alone. And you did the 70 billion in orders. So the main point of that, though, within the company, in the finance org, Elon himself, but also the existing investor base, they have more confidence that the retail investor base will see that valuation grow and be sustained, and that they have a better understanding of this company than Wall Street does.
That's
and
crazy.
Wall Street, if you're listening, that's what they think.
That idea is, I don't mean it's crazy, like I don't believe it. I mean it's fascinating and a little bit surprising. Sri, right? The idea that the retail investors have a better idea of what this company not only is now, but will be in the future than Wall Street. Can that be true?
Look, if you're a naysayer, you can believe the poo-pooing by someone like a Jim Chanos and talk about the data centers in space, factories on the moon, colonization of Mars. It's the stories that the bankers have to tell, and that has to justify the valuation. But on the other side, if you look at the man running the bank, leading the IPO, Goldman Sachs CEO David Solomon, who seemed happy, relaxed, chatting with Taylor Swift yesterday courtside at the Knicks game.
Nice.
That tells me that the banks are confident about how it is going.
Who was chatting with Taylor Swift?
David Solomon, right before the game.
Okay, because I saw Paul Tudor Jones sitting right behind her. Did you
There
see
were
that?
a lot of power players on Wall Street there. But my point being that if anything, is an indicator of where the banks see this IPO heading, at least in terms of demand. And yes, there is tremendous retail demand. We've seen that. But if you actually look at the numbers, the 70 billion in orders and roughly what they'll be allocated, that sounds like about 4 times oversubscribed. That is true for the overall allocation as well. So there's same kind of demand that you see on the retail side that you are ready and willing to dismiss as the cult stock effect. You're seeing on the institutional side as well, even from the big Middle Eastern funds, the Saudis, the folks in Qatar, the Kuwait folks in Kuwait, they're all putting in billions of dollars of orders. And again, there is tremendous interest there. So there's no question that they will be able to meet the requirement for a $75 billion raise.
Of course.
Possibly even raise it if they want to beat that Google number and get it to 85 to 90 billion. That possibility exists. How it will trade after that will still be a challenge because of the very specific quirks to this IPO.
Can I just ask, because we haven't discussed on Bloomberg TV that I know of, what's your intel on who's going to get allocations? Who's going to get the syndicate? Because I'm sure there are a lot of investors right now, I'm talking to retail, right, who are like, how much am I going to get? What do you know?
There will be some folks who will be very disappointed.
There'll be loads of folks that are very disappointed.
Again, when you
have
an order book that is so many turns oversubscribed, of course you will not meet the demand. There will be some people who will put in inflated orders knowing that their full order will never be met. But I think with the fact that you have 23 banks, the various distributions that you have, some banks very specifically looking to raise money from US retail investors, from Japanese investors, from European retail investors, you know this will be spread around, and that love needs to be spread around to ensure that not only do you meet the demand on day one, the price stays up going after that for the next few weeks and months for the banks to be certain that this is successful.
I want to get away from Wall Street, excuse me for a moment, and ask Ed more of a science question, because we had a couple of investors on today who disagree on putting data centers in space. Bruce Richards said it's going to be way cheaper, right? Because they don't have to deal with the cooling issues, they don't have to deal with the energy issues, or they won't cost as much. Marc Ganzi, who builds them on the ground, said it's a science experiment, and there could be a lot of problems with installing and servicing a data center that's not on this planet. Which is it?
What's so interesting about the mechanics of the last 7 days is there was actually a roadshow that took place, even though they priced this IPO early at 135. My understanding is that a lot of the time the banks were doing some work. They were trying to re-explain the orbital data center story. There are ranges. Obviously the existing investor base are very, very bullish on that concept. Many of them think it will happen sooner than was outlined in the prospectus, which is as early as 2028, you'll start seeing deployments. The issue is that it was only 3 days ago that Elon Musk actually showed us a design. So same thing we always say, Elon Musk often misses the timelines that he sets out, but does get there in the end. And that is the attitude towards space-based data center. The proxy is Starlink. SpaceX is undisputed champion of not the world, but outside of this world, of building satellites at scale and putting them into orbit. The design of a space-based data center is just a much bigger satellite. 2 large solar arrays, a radiator, and the body contains the compute. And in some ways, to many, that it's as simple as that. You need a very large radiator to dissipate the heat. And again, it comes back to one central thing, which is why I'm really glad that we carry the tests on Bloomberg Television. It's all predicated on Starship working. Why? Starship's the only vehicle capable of putting something of that scale into orbit.
Because it has to bring a lot of tonnage up there.
Yes.
I mean, Bruce Richards was saying a 1 gigawatt data center needs 500 acres. How many satellites can you fit on 500 acres?
Well, again, we don't actually have the designs of how it deploys out the side. So Starlink in the demo, it comes out like, do you remember Pez, the sweet dispenser?
Do I?
Okay,
Do I
so
ever?
dear America and the world watching, Pez is how it works with Starlink. The assumption is it will work the same. Right now, Starship demoed can do 35 metric tons to orbit. On paper, 150 metric tons, and they have a pathway, they would say, to 400 metric tons. So the tonnage will work. How it is dispensed out the side, who knows? But again, that's why we read the prospectus with a fine-tooth comb, because it's all detailed there in how they're proposing to do it.
Right? Or not, right? Because not all of it's detailed there. Like, how is it going to actually work? As you point out, we've only been showed, a back of the napkin sketch by Elon Musk 3 days ago.
Right, and so this is a referendum on Elon Musk, right? Because either you believe him or you don't, whether you're an institutional investor or a retail investor.
This is why we watch Bloomberg Tech. Ed Ludlow is the co-host of Bloomberg Tech. Wall Street correspondent Sri Natarajan has yet to get his own show, but you should. You should have your own show, I think.
Only if it's with Matt Miller.
I'm going to put in a request with the boss. Don't miss our interview, by the way, with legendary short seller Jim Chanos. That's on Bloomberg Money tomorrow at 12 p.m. New York time. That is Tom Keene. He got his own show with Scarlet Fu, and they will talk to Jim Chanos tomorrow. Coming up, we head to Washington as President Trump threatens more attacks on Iran.
We hit them hard yesterday, and we're going to hit them again hard today, in case you miss it, in case you don't turn on your television set. And we'll see what happens with the deal.
President Trump is threatening more attacks on Iran. In a Truth Social post, he said the U.S. will hit Iran, quote, very hard tonight and take control of a key Iranian oil hub, much like we have with Venezuela. Joining us now is Bloomberg Washington correspondent Tyler Kendall. So, Tyler, what do we know?
Well, Matt, at this point, President Trump is renewing threats that we've heard from the White House before to both hit Iran harder, but also potentially take Karg Island. But the U.S. has really been framing this escalation in both strikes that we saw overnight and new rhetoric this morning as trying to force Iranian concessions at the negotiating table. As people familiar with the matter do confirm to us that negotiations are ongoing, with Qatar playing an increasingly important role in the diplomacy. Our reporting also out within the last hour, seeming to confirm that senior national security officials from both Iran and the UAE met face-to-face for the first time today since the start of the conflict began. Of course, the UAE has taken the brunt of Iran's retaliation when it comes to Gulf states in that region. So it's definitely something to watch here, as we know that regional partners are trying to urge a diplomatic end to what has been the worst flare-up in fighting in recent days. Now, President Trump, in an interview earlier today with Fox News, downplayed the idea that the next move from the U.S. would be to hit Iranian civilian or energy infrastructure sites. But he did say that we should expect later today to be an even bigger strike than what we saw overnight, where the U.S. hit dozens of Iranian military sites. And, Matt, we saw Iran respond by targeting several U.S. military bases in Bahrain, Kuwait, and Jordan.
All right, Tyler, thanks very much. Bloomberg Washington correspondent Tyler Kendall talking to us about what we can expect from escalating fighting during the ceasefire in Iran. Let's get a check on markets as we head to the top of the hour. We're looking at continued gains on the equity indexes. Right now, the S&P 500 is up just 10 points to 72.76. The NASDAQ itself has cut in half the gains that we saw just 10 minutes ago, now up 0.5% to 28,669. So the gains tempered a bit at the top of the hour. Yields coming down. Oil continues to come down. Coming up tomorrow, Seema Shah of Principal Asset Management, Joanne Shu of the University of Michigan, and Interstellar Labs CEO Barbara Belvisi as SpaceX starts to trade. This is Bloomberg Open Interest.